All right, we're recording this, you guys, and you will be sent a copy of this after it's all said and done. When that copy comes to you, I say watch it again, please. And not for me and not for views and all this other stuff. It's actually for you, because I believe firmly that if you learn something and review those notes or review what you've learned relatively soon afterwards, you're going to remember it. You're going to understand it. The first time through, the way I teach and some of my rules might be counterintuitive to what you've learned before, and you're thinking about what you've learned before and may have missed how I've explained it or something else, which happens to all of us, right? When we have a question, we kind of get stuck a little bit. This way, when you watch it again, you will remember it. It will make you a little bit more clearer of concept, and you won't have to relearn it down the road. If you wait down a month before you watch this again, it's going to be like you're relearning it all over again. So try and avoid that pitfall. Learn these as you go, and you'll be much happier for sure. So this will be sent, so make sure you check it out. And this is for a bullish bias. Now, of course, I've got this thrown in there with the, I'm going to start out with my little thing here. The long call spread. We got to pretend we don't know we're doing the long call spread, right? We just have a bullish bias. Think about it that way, because that's really how we come up with our trading strategy is a lot of times, right? We're flipping through the charts, or maybe you hear something, you've seen a new product that you love. You know, one of my big trades I always like to talk about is when Yoplait Yogurt came out with the yogurt drink. I thought it was the most brilliant thing ever. You know, if you take a little yogurt cup, and that's 50 cents, and you add a bunch of water to it, and sell it for twice as much, then that's a pretty good product, pretty good profit margin. So something like that might think, okay, well, now it's time to go out there and buy the underlying stock because I think this product is going to do really well. All right. Let me get a couple of things out of the way real quick, though. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary, snark, or whatever else may have come across on the TV. But I started out trading in college with some money I had earned, and then moved straight to Chicago, never built a resume, and started working on the floor. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Real quick, any opinions, news, research, and analysis, or other information provided by Pro Trader Strategies, associated companies, or employees is for general commentary and does not constitute investment advice. And the reason why is we firmly believe we're here to teach you. I want to teach you like how to fish so you can go out and fish on your own, right? I want to teach you how to trade these strategies so that it fits your portfolio. If I hate Tesla and I'm always saying I'm bearish Tesla and we need to buy puts and because it's perfect for buying puts for Tesla, and you're like, I own 6 Teslas and I love this product and I think it's going to go through the roof. Well, then my advice is counterintuitive to your portfolio, right? So you have to take what I say. Just because my market direction doesn't fit your market direction doesn't mean that these strategies and these rules won't fit your trading parameters as well. It will. But what I talk about with the underlying may not fit your investment parameters. Okay, so do your own homework, and past performance of any trading system or methodology is indicative of future results. All right. Last thing is, you can follow me on Twitter at Wolfman's blog. I do daily market commentaries, a lot of you guys know. So I talk about all the trades that I've done up until that point when I shoot those videos, right? And in the afternoon, then I may do some other trades or get filled on some of those trades I was talking about that I was working throughout the day. So keep your eye out on Twitter because I might tweet that out that, hey, I finally got filled on XYZ. I'm not going to necessarily tell the way to make the sausage in those. I might just say, hey, I sold puts. Well, you know, if I just went out and sold some naked puts from watching these videos and daily market commentaries and things of that nature, you know exactly where my strike location is. All right. So that's how I'll play that. So for some of you guys that are a little bit newer to options trading and may have wanted to start getting involved in it, I want to go through a couple of things. The options 101, Delta. Delta affects that options premium in relation to the underlying's $1 move. So now what does that mean? Well, let's just take FXE, for example, because it's up here. And it's a $100 stock, trading 107.01. So when we go over to the option montage over here, this is the option montage, everything involved in this whole screen, all right? So we want to go in here and figure out how delta is going to affect our option premium. And we look over here, this is the delta column. So all of these are deltas. You can see the ones that are in the money are a much higher number than the ones that are further out of the money, because this will increase by every dollar increase in the underlying. So for instance, if we're looking down here at XYZ, this is a 36 delta. So what this is telling us is when XYZ or FXE goes from 107, so we're looking at 107 to 108. Now we're saying this underlying is trading 108. Let's just say we're throwing it in here. It's 108, and we'll make it 0.07 because we want exactly a dollar move higher, right? So now we've gone up to 108. If this underlying was right here and we bought the 108 calls, let's say, and the 108 calls are trading right now, and the underlying is 107.07, and then it rallies up to 108.07. This premium right here, these premiums will increase by the amount of the delta, so 36 cents. So now the underlying is trading 108.07. Our 108 calls are now going to be trading 36 plus 50, 86, somewhere around the 86 area. These are going to be 85 bid at 88 offer, all right? So $1 move higher, this premium gets added in to the premium here, okay? That's on the first dollar move. Now, if we go on and look at the second dollar move, that's where this gamma comes involved. All right, so now we're going to be looking at gamma for the second dollar move. And this is the column for gamma. So the first dollar move, we talked about the 36 cents adds into that 50 cents. Well, now we're talking about this underlying being at 109.07. The first dollar move we already accounted for. This was trading at, let's say it was trading at 86 cents, right? It's the 50 cents before on the first dollar move, because this is the first dollar move, 107. So it went from 107 to 108, right? So when it went from 107 to 108, we added in the delta, which was 36. So now we have a total of 86, right? We're looking at $86 or 86 cents for this underlying. Now it's moved up to 109, right? So now we're at 109. So our premium is 86 cents. Now we add in the gamma to that delta. So now we have 36 cents plus the 18 cents. We're looking at a total of 54 cents, right? So now we've gone from 86 cents when it was 108 and added in that extra, what did I say it was? 54 cents. 54 cents to it. And now our premium should be somewhere around $1.40. So when this underlying is trading 109, our premium here on these 108s would be now $1.40. Does that make sense? So that's how gamma affects the delta. It adds in to delta on the second dollar move. All right. And it's a roundabout, you guys. Everything can change, right? Volatility, all of those things can affect delta and gamma, all right? So that is, if all else was equal, right, that's what would happen. And then we can look at, sorry, that was gamma. So gamma is the rate of change to delta, right? That's what we talked about. It went from, we added that extra 56 cents into our 84 cents. So it's the rate of change. in regards to delta. So that's the gamma over here in this column here, all right? Because it affects the gamma. And then we have theta. Theta is the impact of time on the premium. So every day that ticks by, theta eats away at this underlying's premium. And it's always going to be a negative number. You know, way out here, theta has already eaten away at all of this stuff. There's not a whole lot to eat away at, right? I can't go negative. So theta will be eating away at our premiums. And the further you go out the curve, you'll be able to see it. Theta eats away at these premiums out of the money a little bit more. But theta will decrease the premium every day. So tomorrow, if all else changes or all else stays the same, volatility didn't change, the underlying is still at 107.07, then the premiums here would go down by 1 penny per day. Okay, so that's theta. Positive when you sell, yes, because good point, Trevor. Theta is always negative the premium, but if you know, and all of these premiums are on the assumption of buying. Okay, but as Trevor points out, if you sold this, well, what happens when you sell something, right? Well, it's simple math. If I sold a negative, that equals a positive, right? So Trevor's saying if I sold this premium, then theta becomes a positive for me. Yes, it's still going to eat away at this premium though, but that is a positive for our strategy, okay? Is all we're saying there. But right now, we're just looking at it from the simplest aspect is theta will constantly eat away at your premiums, all right? Just know that going forward. And then we finally have the volatility. And volatility, it measures the change, or Vega measures the change in volatility. So when we're looking at the option montage again, we'll go back over here and we're going to be looking at this Vega column right here, right? And Vega is the volatility. So we're looking at this being, 6.03. What Vega is telling us here, at these different little levels, that when this goes from 6.03, now we're at 7.03. These premiums over here are going to increase by the volatility, right? So it would go from 90 cents, mid-market to $1 and, what would I say, 90 cents. Yeah. So then it would go to $1.09. So after volatility increase, what we talked about, it would be trading mid-market around $1.09. All right. If it had gone up by that 1 percentage point. All right. So 1 percentage point increases, obviously you can do the math, 2 percentage points, it'll keep going, right? Vice versa. If this went from 6 to 5, now we said, all right, well, now we've gone to, a 5. What happens when it goes down to 5.03? Well, volatility has gone negative by 1 percentage point. Well, that means that this becomes a negative 19 cents. So if volatility went down to 5, then we would subtract that 19 cents out of that 90 cents, and we'd be trading at 71 cents then, right, on the downtick. That makes sense? D is saying, so is it when you sell, do you add the theta to the bid or the ask? No, when you sell, all it is it becomes a positive to you, for you. You know what I mean? Theta is helping you in a sense because you want that theta decay when you sold that premium. All right. You want that premium to go to 0 immediately when you've sold. All right. So all it is saying is really, it's just a positive to your trading strategy. Does that make sense before I move on? Because I want you guys, one thing I may or may not have mentioned before or after this started, please feel free to reach out with any questions as we go along. Because one thing I am an advocate of is the fact that you guys our clearer concept before we move on. I don't want to wait to the very end and have you have all these questions because it could snowball on us, right? I want to get clearer concept, move on, and make this more interesting, because the last thing you guys want to do is just have all my pre-prepared remarks, right? So now we've got all that stuff out of the way, just some of the basic options. Now we're getting into the idea as, all right, we've pulled up a, let's just say, you know, this is your daily routine. You know, you're going through the charts and you're like, bang, 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 right? So I've come up with I found an underlying, all of this stuff, and I'm trying to figure out, the first thing I need to know is, what direction do I think we're going? Well, if your answer is, well, it could stay right here, but I'm bullish. Remember last week we talked about the long call, right? Long call, we are pretty darn bullish. As a matter of fact, I said with the just long call, you're as bullish as a matador. And when I was saying matador, I was saying you're bullish as a capital M-A-D, like you are crazy bullish matador, all right? This should be a D that way, actually. I was trying to make a capital D. All right, so you're crazy bullish, all right? Somebody's cracking me on the on my hair over there. But this one right now, we are just going to be kind of looking at being neutral to bullish. So we're going to try and set up a strategy where we're bullish, not as bullish as the long call. So, you know, I'm bullish, but I'm thinking, you know what? I think it's going to break out of this area, but what happens if it's neutral and I don't want to lose all my money? Well, that's where this strategy comes in, how I build it, all right? We're going to be looking at getting rid of all of those components we talked about that could be negative to us. And some of that is the theta, right? If we are buying something, we're getting long something that I told you that theta is going to eat away at you every single day. So there's a lot of things that have to go right for us in order to not just watch our premiums erode to zero. We have to have the market moving in our direction, all right? But if we can counteract that, then, you know, then you can get away with being a little bit more neutral, right? And then the bullish, you know, you're ultimately bullish. You are bullish, but you're a little bit worried about the neutrality of this, right? Maybe the market's been trading in a tight range like this, and you're thinking it's going to snap now, you know, which we see. That's kind of the idea. But if it stayed in this silly trend forever, then, you know, at least we aren't worse for the wear by having this strategy on, and we're long and we're worried about that theta decay. What happened to your long hair? This picture was, I don't know why it's not going to that picture. Probably because I wrote on here maybe. Hold on. Let me see if I have to, there you go. That long hair, that's me now. I get a haircut like twice a year. So sometimes I have long hair and sometimes I don't. So ultimately we come up with this neutral to bullish thesis, right? So, all right, well, what kind of strategy goes with neutral to bullish? Well, we're going to kind of end up with long call spread. All right. You know, again, you know, this is in the back of your head. I want you to go through this step by step. You know, you're thinking, all right, what direction do I think this is going? Well, I'm kind of neutral to bullish. All right. So now we have to go on to our essentials to success and how we figure all of this stuff out. Well, the first thing is we obviously have a neutral to bullish market assumption in XYZ. All right. Well, is XYZ the right underlying to be trading even options with? And we do have to know that. So my rule for this is when we're looking at XYZ on a stock that's under $100, we go into the option montage and we try and find option montages, all of this stuff with all this beautiful numbers going everywhere, changing colors and all of that jazz. But we want to go to the one that is closest to about 35 days to expiration. And this rule will probably fit as well inside of there, but we want to go to the one where there's the most time and volume. And during open market operations, right? Obviously, we just all heard the bell ring. We all know the market's closed right now. And what happens? I get a bunch of canceled orders as soon as that bell rings. And my orders aren't represented in the market. So you need to look at this when the market is open for picking the right underlying. But EEM or any stock under $100, we need to make sure that our width here on the one that is the spot month, or the one that has the most participation in, has a bid offer that's inside of 10 cents wide. You can see these are about 7 cents wide. This one's 3 cents. This one's about 7 cents again. So that fits the rule. It's a stock under $100. These markets are tight enough to trade the underlying for options. Now, if we look at something that's over $100, like PepsiCo, all right, we move the decimal 3 ticks to the left, and now we're looking at the strike 12 cents wide, right? So we look over here, bid to offer in the one that is closest to expiration, or closest to 35 days to expiration. This is the monthlies. We're not necessarily looking at the weeklies. The weeklies will almost always have less volume and open interest, okay? We can trade the weeklies if it fits this rule, because I will tell you there are going to be some eyeballs on these markets here as well, okay? But most of the people will be trading here, all right? The rule of thumb for this, though, applies to the monthlies. And you can see Pepsi, we moved it 3 ticks to the left. That fits the rule of 12 cents wide. You know, if you are have a more or a higher risk tolerance than I do, then, you know, you can start looking at it. I talk about red lights, green lights, and yellow lights. You know, if it fits my rule of move the decimal 3 ticks to the left, all right, and it fits that rule, that's a green light. If it's just outside of that, say by, you know, if it's over $100 stock especially, you know, and it's between $102 or $100 and $200, then, you know, maybe a nickel outside of that would be a yellow light. You know, $300 stock, you could say, well, all right, maybe it's 5 cents for every $100, kind of the way that I usually ballpark it, outside of my parameter. All right. Then that's okay. Just know we're looking at a yellow light. And anytime you get a yellow light with a bunch of legs of these spreads, you have to start worrying about it, because you're giving too much edge. If you're trading, you know, $100 stock and the bid offer is 25 cents wide, well, one of the things we talked about, let's say it's 25 cents wide to the bid offer. Well, that means to get to the mid market, if it was $1 bid at $1.25, right? Now, I have to get into this market and there's only one guy in town. Well, think about it. If I had to go to the mid market, well, that's $1.12, right? Well, maybe I had to go to $1.10. I had to give up 15 cents of edge, right? If I had to sell it at $1.10, if I could only get filled at $1.10, I had to give up 15 cents to get filled, right? Well, what if I want to cover that trade? How long is it going to take me to make up that 15 cents if this market never moves? Volatility never moves. The underlying is still staying the same, but we're just watching Theta tick away, right? Well, as if I sold it, I'd have to make up that 15 cents, and it would take me, what, 10 days, 15 days to get just back to that price, and vice versa. If I bought it and I had to give up, pay from $1 to $1.10, or maybe even $1.15 because I'm buying it. Think about that. I have an uphill battle to get to break even. I've got that 15 cents to make up, and Theta's eating away. So it's a tough row to hoe. So the wider the bid offer is, the more edge you have to give up. All right. And if you have to give up like 10, 15 cents on an underlying that's under $100, that's a long way to move. Like, this would have to move, this underlying or this strike would have to move to make up that, like, almost $2, right? To make up that change, that 15 cents I gave up, you know. This one would have to move 50 cents just to make up the edge that I gave away. Okay, if I were wanting to just scratch. Does that make sense? So that's why it's really important to make tight bid ask. because there's a lot of eyeballs in there and everybody is trying to fall over each other to make a better market, like in this one. You know, if I came in $1.09 bid, this guy's probably going to go down to $1.12. That's free market price discovery. That's why we want to be involved in the ones where there's a lot of participation. If you're in the one that just has one guy, then you are going to be very disappointed because he knows he's the only guy in town. All right, picking the right environment. So we've realized we've got a bullish to market neutral assumption, right? Or a neutral to bullish assumption. We don't know we're doing the long call spread yet. Picking the right environment. So we've got a bullish assumption. We realize that XYZ has pretty good markets. Volatility is our next thing we need to look at. So let's just say that our underlying that we were looking at was lows, because it has really low implied volatility. That's going to be one of the things we need really, right, is the low implied volatility. So I look at XYZ and I see, all right, well, it's got 2.52 implied volatility percent. You can find it here or here. You can also find it on the chart. Implied volatility is just math, you guys. And when we're looking at it, we can say for our implied volatility percent, this is how they come up with the math on it. I take where the current implied volatility is, which is 20, and it's not giving me my cursor. So the current implied volatility is 20. So in the numerator, we have a fraction that we have to take the sum of, and then in the denominator, we're going to divide it by the sum. All right. So in the numerator, we have 20. So 20. So it's where it's currently at minus the low, which is not giving me the cursor right now. So let's see what the low is. The low is 19. So the low is 19. So we've got, bear with me, 20 minus the 19. So we've got 1 in the numerator, right? And then in the denominator, we're going to take where the high is. Let's just say it's 50 because I don't want to lose my math again. 50 minus 19, the low. So we have the current minus the low and then the high minus the low. We take those two sums and divide them by each other, which is 31. So get out your calculator. You know, that's why it's a little bit easier to pop it off with the, I don't know why my thing doesn't want to. So 1 divided by 31 is 0.032. What did we get? 0.025. Well, that's because I rounded everything, right? So very close. Low implied volatility. That means it's in, you know, the 3 percentile of where it's been. It's only just off the low by 3%. All right. So we want to get into this in a low implied volatility environment, because if volatility starts going up, if this market starts moving higher for us and starts coming back up this way, well, what did we learn when we were talking about over here in the trade window what volatility does? We want to start out in low volatility because the one we are buying, the option we are buying, is going to be affected by the Vega. If this Vega goes up from 22 or 21 to 22, remember, volatility adds into that. And as you can see further out the curve, volatility affects it less. So we would rather start out in a low volatility environment because we want volatility to add in as it increases. All right. If it decreases, which, you know, even though it's really low, it could still decrease, and just because it's 0 doesn't mean it can't go further 0. It's still 0 because that's one of the drawbacks of that math, right? If I take the low of 19 minus the low of 19 and divide it by the high and the low, well, we're at 0%. Well, what if it goes to 18? Well, now the current is 18 and the low is 18. It's still 0. All right. So that is a bit of a flaw in the implied volatility percent. But the idea is you can see, yes, when it's really low, it can continue to go lower. It's not losing very many percentage points when it's this low, but it's just like the stock. It's going to have ebbs and flows with volatility. And the idea is when volatility is way down here, what's it look like it normally does? It starts going higher, right? It starts moving back to basically the middle of the road, all right? So that's what we're looking for. If we are wrong, at least we hope to have volatility move in our direction. And that is why my rules are really important for these strategies, you guys, because the way I have them built or set up for you for these essentials to success, that is because we aren't always right about directionality, all right? We always will see times where we are wrong. What I'm trying to do is when we are wrong, directionally wrong, how we can make it so that we are increasing our probabilities of success. So with this strategy, you know, if I were directionally wrong, you know, and the market started going down, as long as it doesn't like supersede the delta, but we started down ticking, we saw volatility go up, we could see this volatility coefficient offset some of my my directional assumption being wrong. You know, if it went down by, let's say, $1, if this market went down by $1, we would subtract the 17 cents from the strike, right? But in the meantime, volatility goes up by 2%. Well, that would mean that 20 cents went back into it. So all in all, our premiums would have increased by 3 cents on a negative move, all right? All of those things may not come to fruition in that way, but you can see why we want to set ourselves up for success if that were to happen, all right? And yes, it could go directionally against us. Volatility comes out, but ultimately when the markets really start moving, volatility usually holds on or increases when we start getting really big whipsaw moves. And that's the way we would be able to handle a delta going against us. All right, so that's picking the right environment. Now, picking the right duration, you can pretty much pick just about any duration with this. You know, this is the theta component. The closer you get, you're going to have more theta to those at the money options. We're going to be looking at some that are in the money and some that are out of the money. We're going to set this strategy up a couple of different ways to show you different ways to put on some risk, if lack of a better word. I like to go out the curve a little bit. You have less theta decay to worry about. We're going to offset most of that theta decay, but you're still going to have a theta component. If we offset it completely, which is possible as well, where we get rid of all the extrinsic value, extrinsic is all theta decay, extrinsic value. There's intrinsic value, which I'll talk about more here in a minute, and extrinsic value. We're trying to offset all the extrinsic value so we won't necessarily see this type of theta decay and stuff like that. But the idea really is I want to have enough time to be right, right? And if I get in here like 28 days or what is the closest expiration right now, you wouldn't pay very much for the strategy. You're going to pay a lot less for that strategy, but your theta component is going to be much more. So if we just looked at the theta component up here, we're looking at, you know, 4 or 5, didn't quite go to 6, but 4 and 5 cents theta decay right here, right? Well, the ones that we're selling are going to have a little bit less theta decay, but the ones when you go really far out, you go further out, we're looking at theta. Look, these are only 2 cents. And we're probably going to be looking at the ones that are about 70 some odd days, and they will precipitously go. It's like about a penny a day less. So I'm more willing to go further out the curve in order to allow myself to get a little bit more time to be right, limit some of that theta decay, because obviously these are going to start, the theta is going to start increasing the closer to expiration. Okay, everybody with me there? So right around, you know, somewhere out the curve a little bit further is kind of like what we're looking for. You can do it inside of here. Just know you're limiting your time, and it's a little bit more theta decreasing. You will pay less, though, when you are here, okay? You're going to pay a little bit more out here, but I'd rather do that to allow myself to be right. All right, picking the right strikes, right? We've come up, we know XY, we have our bullish assumption. We know XYZ is the right underlying because it's got tight bid-ask, a lot of participation. The environment's really low. We looked at that. Duration, you know, it's a little bit vague. You could say if I'm going in here, that's a yellow light. You know, you can go way out here on the curve, but at the end of the day, I'm never in a trade for that long, 90 some odd days. So the sweet spot for me is right in here, the 70 to 50 some odd days to expiration, okay? So picking the right strikes. We need to make sure we are looking at this as a 1 standard deviation type of move. So I like to set this strategy up first and foremost, with the 84 delta in the money long call, okay? And then we are going to be looking at about a 16 delta short call, okay? So when we're looking at buying the in the money call, that's the 84 delta, and then selling the short out of the money call, that's going to be around that 16 delta. When we set it up like this, we are going to be looking to try and risk one. We're going to try to do this so with the in the money, if it's the in the money to the out of the money, all right, I'm just going to say the in the money. The in the money one, we're going to start out with that 84 delta that I talked about. All right, we're going to try to make it so we risk one to make one. All right. All right, to make one. Make. All right, so that means if it's $10 wide, if the strikes are $10 wide, being like $100 to all the way to $110. Okay, sorry, getting used to my new pen with mouse. $100 to $110. That's $10 wide, right? We would only want to pay no more than around $5 for that. If you paid $5 and let's say 75 cents, or that's where it was, just know we are looking at, this is a green light, green light, yellow light. And if you're basically paying, 6 something, 6 plus, that's a red light. I'd walk away from it. All right. So I like to start out with the in the money option, about an 84 delta. And we are going to find sometimes it doesn't work out where we're paying a little bit too much. We're paying over that 50% of the width of the strikes. Then we're going to have to kind of default out to this. We're going to have to default out to the one that's about the at the money. So about the 45 delta or something like that. Okay. And then if you're picking the at the money, what we're doing is we're looking to pay only 33%. Actually, I was going to do that as a percent. 33% the width. So in that example, off the top of my head, if it's a $1 wide spread, we got dollar wides on our strategy, then I'd only want to pay 33 cents. Okay. And that's with the at the money. We're going to be looking at about a 40 some odd delta. All right. Pretty close to at the money. And you'll pay a lot less for this one. But remember, now, because it's at the money, we are going to have a lot more of that theta component that we talked about. Because when we were talking about in the money, when I was talking about versus the out of the money, let's stick with lows. It fits my rules. So we're looking at the 84 delta. And obviously, I have a position on in this strategy, even though this is my account that I use for the daily market commentaries. So I throw all this stuff in here if I do a trade. So we're going to look at buying the 84 delta. That's what I was talking about, right? So we're buying the 84 delta. And then I said we're going to look to sell it around the 16 delta, right? So we've got a lot of room to be right. I've got $25 wide. It should be about $12.50, okay? So this one isn't fitting that rule. So now what do? I've got this bullish assumption. I've got really low implied volatility. I know it's going to go higher. I think that it's going to go up and test this area up here, you know. All of those things are what we're talking about. Maybe make new highs. Maybe I did a chart thing and I think it's going up to 125, okay? However you come up with your directional assumption and rate, you know, things of that nature. So that doesn't fit the rule. Next thing I'm going to do is just check the one that is at the money or very close, you know, just slightly out of the money for this strategy. I'm going to look to buy that one and then make it about $10 wide. Let's see what we got. I make it $10 wide. What was my rule for the one that's the at the money? We're going to make 33. We want to get about 33% the width of the strikes. Well, we can see that this is only 30% the width of the strikes, right? I lose anybody on that math? So this would probably be the one that I opt for on this strategy because it fits the rule. This one, when we were looking at the in the monies, we were paying a little bit too much, okay? This one, we need to have a bigger move in order to be right, but we aren't risking as much, all right? So that's the levers and pulleys of that, right? I like to, if I can do the one with the in the money and the out of the money, I'm doing that because if I look at it, if I bought the 84s, all right, this is what I was talking about, intrinsic and extrinsic value. All in the money options have intrinsic value and extrinsic value. All out of the money options are all extrinsic value, which means it's theta decay. It's what is going to go to zero, all right? It's what this strike is worth. This strike is worth the intrinsic value, which is zero. This strike is worth the intrinsic value because if I bought this call at $14.55 on the $100 strike, right? Well, that means that the stock is 114.55, right? 14 plus the 100, 114.55. No, I tricked you guys. It's not April Fool's, but I did trick you guys. There's intrinsic and extrinsic value. There's theta decay in here. Well, what's the theta decay? Well, it's the difference between 114.55 and 130 or 113.32. What's that difference? It's $1.23, right? $1.23, yes. So it's $1.23. Well, here's a little floor trader hack for you. And it's always close and it's worth, you know, saving some brain cells, all right? So if we look at XYZ stock, the 100 strike, that's in the money. The real fast floor trader hack is look at the corresponding put. What did I say it was? $1.20 something? Well, this is saying it's $1.10, all right? That's close enough for me not to go through and bust my brain over all that stuff because when I'm trying to figure out if this strategy is right, I don't want to have to do every single strike and figure out what the intrinsic and extrinsic value. I'm going to use my floor trader hack and just go straight over to the corresponding puts and say, hey, that's my extrinsic value that I got to pay for. And remember when I was doing this strategy, I hit this one. Well, if I'm buying this much extrinsic value and that's all theta decay and I want to offset that, well, I really probably shouldn't be selling these 125s. I want to at least cover all the theta component, all right? Beauty in this is when you do that, now you know where your break even is on the in the monies. You take the 100 strike and add $12.43 to it. Well, now my break even's below where the underlying's trading by, you know, well over almost 90 cents, right? So I'm able to have my break even. So I have about $1 move down from where it is currently before I hit my break even. Another reason why I like that in the money one. I can be a little bit directionally wrong and still not have to worry about it too much. And most of that is because I sold this strike for $2 and I only paid $1 something in extrinsic value. So all of the rest of that goes for towards my strike and the intrinsic value. All right. Now, with this one, we're $20 wide. It's still not meeting my rule. All right. So even though I played around with it, it's not always going to work out. Okay. If it doesn't, then I would opt just out of these and say, you know what, I'm just going to go with the $10 wides. I'm paying a little bit less than the third the width of the strikes. That's where I'm going to go with that one. You need to be a little bit more bullish, though, when you do this. All right. If you are really concerned about this being just completely market neutral, well, we've talked about this. If it stays market neutral and stays right where we are, this is all theta component, because this strike is really worth nothing in 78 days if we don't move. This one is, if we don't move in 78 days, I'm still only having the extrinsic value, right? If I did this one, even though it's not, if I did this one and it's not fitting my rules, or it did fit my rules, let's say, I know that I can still be directionally wrong and be right. And that's one thing I always preach is, how can we increase our probabilities of success? Well, one of these is, if you're directionally wrong, can you be right? And that's the thing that I'm constantly going over in my head, because I'm not always right about the direction or the underlying. And neither are you. Neither is that guy that out there always touts that he is. Follow my strategy because it's always right. Well, no, it's not always right. And what do you do and what have you done to make sure that you are going right? One of the few things that we can do, you guys, when we're trying to be right or trying to make money, is setting up a strategy in an environment, in and around where we can increase our probabilities of success. And by setting it up with the in the money, collecting more than the extrinsic value or that theta decay, we don't have to worry about volatility now. We don't have to worry about theta decay. So we have to worry a little bit about volatility, but usually not a ton. As a matter of fact, on this one, you can see we wouldn't have to. Just check your volatilities and make sure. So we've pretty much offset all of those other things for us, which increases our success rate, right? This one out of the money, we have to get up there. We have to make a move in order to be right at the end of the day. So you just have to be a little bit more bullish when you're setting it up this way. There was one other thing that I wanted to mention while I was doing. Oh, when you're doing it like this 84, the 84 and selling the 16, this is also a synthetic collar. You guys hear me talking about synthetic longs, synthetic shorts and stuff like that. It's a synthetic collar. And Mark Cuban made the collar famous way back in the day when he sold his first company to Yahoo. What was it, broadband or something like that? Whatever the sports thing was. How he made all his money. And what he did was he got all this stock from Yahoo. And Yahoo came to him and was like, you got all this stock. We're all good. You know, that's part of the payment for this. But you can't sell it. You can't sell our stock for the next so many days. All right. So what did he do? He went out there and bought a put around Yahoo at around the 84 deltas or around the 16 delta put. So basically he was buying, he would have bought this put and then he would have come up and sold this call, right? Well, what does this tell you when you have the underlying trading right here? If the underlying goes below 100, he's out at 100. If the underlying goes above 125, he's out at 125. Well, he really didn't care where he was out of. He wanted to be out today as soon as he got that stock. He didn't want to know, he didn't want to hold Yahoo stock. I think he knew that he sold him a pig in a blanket and was trying to, or a pig in a poke, sorry, pig in a poke, and, you know, didn't want to be around when the cat came out of the bag and wanted to make sure he was connected. So he did a synthetic collar around all of his stock so that he knew he was getting out at the location he wanted, right? And literally he got out on the high. But with this, we are doing a synthetic collar because I have no risk below this 100 strike, right? But I get to participate on all the upside. You know, if you had the stock, it's 100 delta, you know, right? XYZ stock is 100 delta, it goes up by $1, it increases by $1. All right. This goes up by $1, it increases by 84 cents. Well, that's a product of being synthetic when you had the short calls, right? And the puts. You're no more risk to the downside here and no more risk to the upside. So it's a synthetic collar. And it's it acts just like the stock with defined risk all the way around it. You limit your risk to the downside, you limited your risk to the upside. All right. So knowing your exit strategy. If we are doing it with my rule here, with the 84 delta and in the money, and we're selling the 16 delta, basically we're taking our premium, and once it increases by 33%, that's when we're out. The easiest thing to do is look at this. When it, if it was, we had the $10 wide strikes, we got $10 wides, we paid $5 because we're paying 50% of it, right? Now we need to take that $5 and multiply it by the $1.33. All right. So once that underlying increases by the $1.33, so $5 strike. Let me make sure I did this. $5 times the $1.33 on this, then we're getting out when it's at $6.65. If my short strike is hit, we're easily achieving this. All right. And I don't want to hold on to this till I get the full width of the strikes, you guys. I want to beat the probabilities. I told you, probabilities of that 16 delta, probabilities of the underlying finish. Delta also tells us the probability of the underlying finishing at 125 and a penny is only a 16% probability. So if I've seen this go in the money, I know there's only a 16% chance of it being in the money at expiration, and I've beaten those probabilities. Get out. All right. I see a bunch of questions coming up, and I'm running long in the tooth. I'm going to try and get to those, but let me get a couple of things out of the way. So that one we're looking to get out for a third increase. On the other one, where we had when we were looking at collecting, we pay a third the width of the strikes, right? Where we're looking at those out of the monies, or the at the money ones, where we're doing this one and selling this one. Well, I paid $3.09 on a $10 wide. Once this doubles in price, I get a double on this, gets up to $6. That's where I'm getting out. Or 100. I used to say it was a 50% increase in the premium. That's not right. It's basically a 100% increase in the premium. That's what we're looking for here on the ones that are out of the money. So it goes from $3 to $6. I'm out. All right. The one that's in the money here, the 85, let's just say it came out to being correct. Then I would multiply $12.50 times $1.33, and that's where I'm getting out. All right, so that's our exit strategy. Make sure you write it down and get it. If you're setting this up on technical analysis, right, I think it's going to go to wherever, and that's my out. If it breaks below, get rid of my, I want you, go away. Something's not wanting me to work. All right, so if I said, I think it's going to rally, but if it breaks below this area right here, 110, I'm out. I don't have a problem with that. All right. If it's the 84 delta one, it decreases by, it goes from $12.50 to, like $6, then I would look to get out. Okay. I'm usually going to ride these out and play the probabilities. But if your directional assumption changes, you get a gut feeling, like all of a sudden you see something on the news and you're like, that can't make my strategy look very good. Get out. Don't wait for the technical analysis. Always go with your gut. I mean, I don't care. You get that inclination. That's a change in your assumption. It's your body, your brain trying to tell you without a voice. It's part of your limbic part of your brain that doesn't have a voice, but it has reasoning and it has feeling. But how do you convey that feeling to somebody that they're wrong? It's trying to, but you're not listening. All right, max profit is the short call minus long call. The reason why I did this backwards so you don't get a negative, but it's the width of the spread minus that premium paid. That's our max profit. Our max loss, anytime we pay a premium, is that premium, right? And finally, our break even is that long call strike plus the premium paid. You remember I kind of went over that a little bit. We added what our premium paid was into our long call, and that's where I said we were coming up with our break even on that. That works for that in the money one, and it's only at expiration. All right, I see a couple quick questions coming up. I'm going to throw up the platform real quick and see if I can answer those here. All right, so you bought the 100 strikes, and did you find the corresponding put which gave you the call to sell? Yes, if you're talking about in regards to I own Lowe's, right? So I own Lowe's, and I'm doing the Mark Cuban. Somebody gave me, 100 of the underlying, okay? If I had 100 of the underlying, what I would do is I would go in and probably buy this one and then sell the 16 delta. He may have gone even closer. He may have been like, I want to get out right here and right now. I don't want to worry about the market moving. I've already spent that money, and he might have been 2 years out or something like that. Wherever, if they said you had to hold on to it for a year, or maybe he said 2 years, then he would probably have done the collar out here, right? If it was like, 6 months, okay, this is where my collar is, right? So he may have very well done this one. But the idea is when you're doing a collar in the market, protecting your portfolio, he wanted out of Yahoo. There's no doubt about it. But you don't necessarily want out of it. And you're like, if we have a major move, a 1 standard deviation move in either direction, I want to be out. Okay? And that protects you to the downside, and you get all of that money to the upside. And remember, there's only a 16% chance that that's going to happen. It's a really low probability. I'll take that all day long, right? And in this case, you collect a little bit of a credit, or actually that's the debit. I paid more for it. So, I'd probably play around with it. I'd try and get this. If I'm doing a collar, I'm trying to get this for no money, paying out no money or collecting a little bit of a credit. But I don't want to talk too much about the collar. More I want to talk about is this is a synthetic collar. Okay. Does that make sense to everybody? How that I'm just like the collar I just talked about. If it goes below here, I'm protected. The puts, I'm protected on the collar. On this strategy, I'm protected on this one. Okay. I hope we can revisit this on the recording. Ian, we can. And maybe even watch, like I told you guys to watch this one again. You can go in and watch another long call spread strategy webinar where I may mention a couple other little things that may make it stick with you a little bit stronger, Ian. I may have talked about this in a process that may make more sense to you. I'm trying to go through this like a trader's perspective where you're looking at charts and you've come up with a directional assumption in XYZ. And I haven't really traded options, but I trade a lot of futures and stock outrights. How do I do this with the options? And this is how we kind of roll into those options. Okay. So, that's why I'm teaching it a little bit different than I will in other long call spreads. So go back and maybe watch one of those other ones too. I may mention some other things, and I may have spoken about it in a process that you would pick up on it a little bit better. Does that make sense, Ian? Doug says, how can I tell by looking at Vega what will happen to the spread with a change in implied volatility? When are you selling one side and buying the other before I enter the spread? Great. So you can look at just the Vega right here and know that if volatility increases or decreases, these are going to offset, right? So if I bought this Vega right here, it's 12 cents. So if I want volatility to go up, right? Because then my premiums go up. Well, then I sold this one, and if volatility goes up, well, now my premiums go up, but it's only by 1 penny. I'm only losing by 1 penny. You're not even going to notice that. All right. But, if you're adjusting these and playing around with it. Obviously, you want, when we're in a really low implied volatility market and you expect volatility to at least remain the same or go up, you know, then you probably want the volatility balanced in your favor. Okay? Just make sure there's not a huge discrepancy. Does that make sense, Doug? You would know that by just looking at these. They're pretty much offsetting. Same with the theta. We're trying to offset that theta by doing the 84 and the 16 and the vega with the 12. You're losing a penny, right? Can you go over how you select the call to sell? I want to make sure if I'm buying the in the money one here, the one that I'm going to sell, I'm looking over here at the put and saying this underlying X. I could go like this and say the 100 strike plus $14.55. All right, that's 14. Now we're add those back in. We're at 114.55. Now what's extrinsic? Well, 114.55 subtract 113.32. Now you know we have a dollar. What is it? $1.23, right? I'm doing the math in my head, but if we have a total of the premium plus the strike, 100 strike plus 114.55, subtract from 113 where the current underlying is 113.32, we've got $1.23 in extrinsic value, right? And the floor trader hack is to look over here, and it will usually be right or within a nickel or so, okay? So it's going to be very close. Part of the problem is this is a 14 delta and this is an 84 delta. Well, this corresponding, if it was 16 delta and an 84 delta, then that's when it's going to work out a little bit better, right? That's where it's going to show that real theta component on that. But I just look over there. I don't worry about any of that stuff. I just say, all right, there's about $1.10 I got to sell. Well, if I sold this one, I'm not getting that $1.10, so I'm going to have to probably move a little bit tighter to collect a little bit more premium. Okay? That answer your guys' questions on that? All right, Banu's asking, on my charts, what are my moving averages? This is the 9-day, the 50-day, and the 200-day. Simple moving averages. I really don't look at those, to be quite honest, very often. I will look at those for support and resistance every once in a while, but not a whole lot. I'm more interested in the market profile myself. Okay. All right. So listen, you guys, if you enjoyed this, you guys want to hear more about how I trade, when and where I find those trades appropriate, take advantage of this, especially if you're a newer trader. And if you're a veteran trader, veteran traders will learn from this. And you know, I'm not just trying to teach you guys what I think is the right way, but I'm trying to teach you guys how to implement this in your portfolio so it's appropriate for you. So I talk about all of these. And this options course is great all across the board, from beginners to the more advanced guys, because I will tell you, everybody out there is avoiding protecting their portfolio against rising interest rates because they don't know how. They're just looking at that bond portfolio. Oh, that's the one that doesn't have any risk in it. Well, when you see interest rates moving, you will see the risk involved in that portfolio. So you should definitely take a look at that and take advantage of it. Also, more odds on how to discern what delta is telling you, all the probabilities. There's all kinds of things I didn't talk about. Options, how to trade gamma. If you want to be a gamma trader where you get that big gamma move, I talk about that. That's more for the shorter duration guys, but I talk about that as well. Market profile here, history of options. This is great for $36. I mean, you guys are going to be able to make up that difference. You know, that's one thing I always try to make sure is that you guys will be able to benefit despite the fact that you're paying for some education here, right? I think that I'm providing at least $36 in value for you guys in this. I think you're getting about $1,000 in value, but because you guys are participating in this, I want to give you guys a taste of how I teach and how I make this stuff come together, come full circle for you, all right? I don't want you guys to be guessing or, you know, wondering, is this the right strike? What should I be doing? You know, if you go online, yeah, you go online, you can find out how to do a long call spread, but they aren't going to tell you when and why or where you need to come up with strikes and or when and where and why you need to get out of these things at certain places. All right. So I go through all of this. It's a great course. It's in the chat window, you guys. We've been going back and forth in the questions box. I threw it over there in the chat window, so you can take advantage of that right now. Otherwise, if you're watching this on tape delay, you are going to have to pause the video now and type that into your URL. Finally, I just want to thank you guys all for participating in this webinar. Later webinars, I'm going to be drilling down on different option components, when and where I find those trades appropriate. Here's the link. Again, you're going to, have to pause the video and type that in. Thanks for watching. If you have any questions, contact us at 310-598-6677 or trading@protraderstrategies.com. All right. Appreciate it, you guys. Take another look at this and see what all you're getting in this. It's over 10, 15 hours and more that aren't even listed here. All right. So take advantage of it. Hey, Buck, good to see you guys. You were quiet today. Thanks for another great webinar. Appreciate the kind words. Thank you guys very much. Appreciate it. Take care, Andrew. Thank you, Ian, Trevor, everybody that was jumping in on all this stuff. D, thank you guys for all the kind words. Take care. If you can't take that, take it easy.